All right, let's stick with this theme of the individual investor who, I got to tell you, is crushing Wall Street. Maybe that's why Wall Street won't change the rules. I'm going to bring in Rob Luna, CEO of Surevest, a CI financial company. And Rob, here's something really intriguing. The shrinking number of Wall Street analysts. I mean, fewer and fewer companies are getting coverage. And obviously, without coverage, that means there are no buy recommendations, no one to really pump up the stock. What does that mean? Does it really mean that is that bad for stocks, or how do you find opportunities when Wall Street's not covering these names?
Well, I mean, look, Charles, they're not shrinking fast enough, in my opinion. When you talk about, Wall Street analysts, they've been wrong for a long time. And you talk about their ability to put out good recommendations. When you look at all the Wall Street analysts, they're always buy recommendations. Charles, these guys, their pockets are being lined by the same companies that they have to recommend or put a sell recommendation out on. That's why, in general, less than 10% of recommendations are sells. I just looked at FactSet before I came on. It's about 6% now. So the average investor is becoming more and more educated, more information out there. They don't need these guys to make investment decisions.
So I referenced the Wall Street settlement, 2003. At least 10 large firms had to pay massive fines, and for at least a year, they had to send out duplicate research from an independent firm. I know because my firm, we won contracts for 5 of those firms. Yeah. You're saying that you think this continues, that this sort of nefarious getting paid for research continues today on Wall Street?
It's absolutely continuing. I mean, you were talking about it before, Charles. Look, we know the game is rigged, but that's the whole thing about looking at it. If you know the game is rigged, you know how to play it. That's going to continue. The traditional Wall Street system is against the average investor, but the average investor is more armed with the same information that's available today. People like you who are bringing in, talking about dark pools, the average investor does not need these guys. Now, look, if you're trying to trade on a tick-by-tick basis, you're not going to get access to dark pools. You're not going to be able to do that, but you don't need to do that today as an investor.
All right. So maybe this is one reason why so many folks have piled into passive investing, right? Yep. And this is when you just say, I'm going to buy an ETF that matches the market. Warren Buffett likes it, he says, because in his mind, the average person cannot beat the market. But some analysts at Bernstein were saying that they were worried that, quote, a supposedly capitalist economy where the only investment is passive is worse than either a centrally planned economy or an economy with active market-led capital management. In other words, they're saying that this thing is worse than socialism, buying passive funds. Do you agree with that?
Well, I don't know if it's worse than socialism, but I'll put it this way, Charles. When you look at the passive index investor, a lot of people who have been there have really significantly underperformed. If you look at the S&P index today, valuations are not going forward, and that's where traders have to do is going forward. I've been talking about a name like Facebook that's rallying today. That's a company that's been trading at the same valuation as the S&P, but growing 10 times as fast. Everyone knows Facebook. Why not put your money in companies you understand that are doing better? You don't have to be an analyst or a rocket scientist to find names like Facebook to invest in.
Well, that's for sure. Hey, Rob, I wish we had more time. Thank you very much. We'll talk again real soon.